for education and entertainment purposes, not financial advice. Josh had just turned 21, and instead of celebrating, he was packing his bags. His stepdad told him it was time to take care of his own life. No argument, no drama, just a clear message. You're on your own now. Before leaving for good, Josh went to the only person he trusted, his mom. And like any parent, she assumed he'd ask for something simple, maybe help with college, maybe support with student loans. But Josh didn't ask for money. He asked for something riskier, something most parents hesitate to do. He wanted his mom to co-sign a house with him, a real house, at 21. And you might be thinking the same thing she did. Is this kid serious? Buying a house at 21? Is he trying to destroy his mom's credit? Honestly, it did sound risky, because one missed payment, one bad decision, and both of them would be in trouble. But Josh wasn't talking about dreams or luck. He had a plan. A strange plan, one that didn't make sense at first glance. Even without understanding the full idea, Josh's mom decided to trust him. She signed her name beside his, not knowing that this risky decision would shape the next decade of his life. And that's where it all begins. Josh left home with nothing but a backpack, a co-signed house, and a plan most people would call crazy. But wait till you see what he does next, because this is the part where the real risk starts. The house Josh bought cost $200,000. 3 bedrooms, slightly old, nothing special. But to Josh, it wasn't a house. It was a lifeline. His monthly payment came to around $1,700. And if you're wondering, how is a 21-year-old supposed to afford that? You're asking the exact right question. One missed payment, and Josh wouldn't just lose the house, he'd drag his mother into bad credit too. That's the danger of a cosign. One mistake hurts both people. So Josh got to work immediately. He didn't waste even a single day. And here's the surprising part. He didn't move into the house himself. Now you might be thinking, he bought a house, but he's not living in it? Then what is he doing? This is where Josh's unusual plan begins. He walked through those 3 empty bedrooms and saw something most people completely miss. Pure opportunity. Josh wasn't planning to rent the home to a single family. He had something very different in mind. Something creative, something risky, something most people would never even consider. Josh's plan was simple. He decided to rent the house by bed. In simple terms, he turned his house into a co-living space. Before doing anything, Josh checked the rules. He made sure his city allowed shared housing like this. Once everything was clear, he moved forward. Josh put $5,000 from his savings into the house. Not for luxury, just the basics. He placed 2 beds in each bedroom, 3 rooms, 6 beds total. He cleaned the house, made it presentable, took simple pictures, and posted the listing online. Each bed was listed at $500 a month, with all basic amenities included. And now you might be thinking, who would actually rent a bed like this? A lot of people. People who want to save money. People who don't want to live alone. People who prefer shared living over paying full rent. Within 2 days, Josh started receiving messages, and within 3 days, all 6 beds were occupied. That brought in $3,000 every month. Josh paid his house payment of $1,700 and was left with $1,300. And now you might be thinking, all this risk for just $1,300? Yes. $1,300 may sound small, but Josh now owned a house, an asset that could grow in value over time, and yes, there was also a risk it could lose value. But the rent kept coming in every month. The house took care of itself. Josh handled basic maintenance once a week, and with the house running smoothly, he did something important. Josh focused on earning more and saving every extra dollar. He started working a side hustle, extra hours, extra effort. One simple goal: save more money. For the next 3 years, Josh followed a strict rule. The house income stayed inside real estate. His work income stayed with him. After 3 years, Josh made his next move. He didn't sell the first house. Instead, he used it. Josh tapped into his home's equity using either a HELOC, a home equity line of credit, or a cash-out refinance. In simple terms, he borrowed against the value his house had already built. He used that money to buy another house. And just like the first one, he invested his savings to convert it into co-living. Same model, same setup, same pricing. Now Josh had 2 houses. Both were generating monthly income, and both were appreciating in value over time. But this is where the risk increased. More houses meant more debt, more payments, more responsibility. If rents dropped, if vacancies increased, if interest rates went up, the pressure would be real. This is what leverage does. It can amplify gains, but it can also amplify mistakes. But Josh wasn't ignoring the risks, he was managing them, and there was another advantage most people overlook: tax benefits. Under U.S. tax laws, rental income is taxed differently than salary. Mortgage interest can be deductible. Depreciation can reduce taxable income on paper. So even while the houses were generating cash, Josh's tax burden was lower than it would be from a regular job. All the money from real estate was rolled back into more real estate. All the money from his work was invested into gold. 2 income streams, 2 asset classes, both growing. This wasn't luck. It was a system. And once a system starts working, scaling becomes inevitable. 10 years passed. Josh was 35 now. On his birthday, he sat alone with his laptop. No party, no noise, just silence. He opened a simple spreadsheet, and that's when it hit him. 15 years ago, Josh had walked out of his house with nothing, just a backpack and a plan no one understood. And now, he owned 8 houses. He owned gold, and his total assets were worth more than $2 million. Josh wasn't a millionaire in his bank account. He was a millionaire in assets. He started crying, not because of money, but because he finally saw the full journey in front of him. Josh picked up his phone and called the one person who made all of this possible. He showed her the screen, the numbers, the houses. His mom looked confused and said she didn't really understand it. And Josh said something simple. He told her, "I don't have millions sitting in my bank, but my assets are worth more than $2 million. His mom smiled. She was proud, and Josh said the words he had waited years to say. This only happened because you trusted me, because you co-signed that first house, because you believed when nothing was guaranteed. He thanked her. Josh wasn't rich because he chased money. He was rich because he built assets, managed risk, and gave time the chance to work. He didn't escape struggle overnight. He outgrew it. Slowly.
The goal of this story was never to tell you, Josh did this, so you should copy him. The goal was to make financial ideas easier to understand. This channel is about using stories to explain finance, so it's easier to understand, easier to remember, and easier to apply. This story is inspired by a combination of real-world investing concepts and experiences and is presented for educational and entertainment purposes only. This content does not constitute financial, investment, or real estate advice. We are not licensed financial advisors. Always consult a qualified and licensed financial professional before making any financial or real estate decisions.